This is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We're going to turn on our line today, so we'll take some questions from our radio and TV listeners. If you have questions about your portfolio, if you're concerned about your money, maybe you're questioning the advice you're getting, maybe you've got a complicated investment issue, maybe your retirement is not doing quite as well as you wanted to because of interest rates going down, maybe the stock market's going up and you're not in it. Maybe you've got too much money in bonds, or maybe you bought some of those non-publicly traded REITs and you're concerned. Give me a call in the studio. And as always, we're going to put our website address up. If you'd like to go visit my website for more information, not only about our firm, but how we actively manage our client portfolios, and risk management is an important part of our money management strategy, go to reznywealth.com. You can also check out my radio show and on the available times on Sunday mornings, and also it gives you replay times for our TV show. We're every Wednesday and every Sunday evening, and of course we love getting calls. When you do call that number, just give your question to one of our studio producers, and we'll take your question and I'll answer it when you're not on the actual phone. This way you can listen at the comfort at your own home watching us on TV. We get a lot of calls every single week, not only on our TV, but also our radio show on Sundays. And what's unfortunate, so many investors, especially retirees, seem to really be sold investments often that are really no more than expensive, mediocre investments that are highly complex that don't actually do your portfolio justice. One of them that seems to be coming up a lot lately is variable annuities. And I can tell you about a half or more of the people that come into Rezny Wealth Management every day, over half actually, have been sold at least 1 to 4 variable annuities. Over 50% of the people that come into our offices have already been sold 1 or 4 of these variable annuities. Most of the investors don't understand what they got themselves into. And unfortunately, variable annuities, like a lot of annuity products, are highly complex. You have to remember, the person that sells annuities is working under suitability. Under the suitability rules, you're suitable to buy an expensive, mediocre variable annuity as long as the parameters are within your goals and objectives. By the way, suitability means it doesn't have to be the best or the best performing or the cheapest. In fact, the exact opposite often happens under suitability. All brokerage firms, people at an investment department at a bank, insurance agents, insurance brokers, typically always work under what's called suitability. So you want to find out, does your advisor work under the fiduciary standard? Is he fee only? Or does he work under suitability, which is about what 90% of so-called advisors work under? And I know he might be a nice person or she might be a nice person, but if they're working under that bad suitability umbrella, your retirement is put at the back of the line. A little bit about variable annuities. And again, because over half the people that come into our offices to hire my firm to manage your money have been sold, and I use the term sold, one of these products, they didn't understand what they were actually buying because these things are so highly complex. Often the person selling them doesn't understand these things any different. Let me tell you a couple reasons why variable annuities especially are dangerous to your wealth. First off, the average variable annuity that my firm reviews has an internal expense ratio that comes out of your return every single year. We typically calculate these between 3 and 5%. 3 to 5% is the average that we see on most of these variable annuities. I've seen it much higher depending which options you pick on that variable annuity. Now, while you might get the warm and fuzzy and that salesman or that so-called advisor talks about the benefits of a variable annuity, often those benefits are not much good when you start taking in 3 to 5 expense ratios yearly against your real return. Many investors that come into my office that have bought these annuities not only didn't understand them, but often make little or no money on return on their variable annuity. The reason is most variable annuities have pretty mediocre investment options and limited. The expenses are high. You add in mediocre investments with high expenses, and that takes away your return. The average variable annuity that I have reviewed and looked at over my years in this business typically run 3 to 5%. The average person that buys one of these products, from a quick calculation, often are averaging 2 to maybe 3% long-term rates of return net of fees, because these things are so expensive. So before you buy the next variable annuity, or maybe you already have been sold a variable annuity and you're questioning that advice, you can always call our office, schedule a consultation. There are ways to get out of these variable annuities, and we can tell you exactly what you're in for. We can also tell you the good and even the bad with your variable annuity. So call our number. It's at the bottom of the screen. We'll put it up for you now. Call the office, schedule a consultation either in Fort Myers or in Naples. But again, if you've been sold one of these variable annuities or any bad investment, or you're unsure what you bought, call us for a consultation. I always tell investors it doesn't hurt to talk and get a second opinion. We also have been getting a lot of questions about our investment style and our investment management. I want to talk a little bit about what makes an investor successful. And I'm also going to talk about what doesn't make an investor successful, meaning what causes you, the investor, to lose money more often than the markets lose, or greatly underperform. The first thing that I want to talk about is this. Buy and hold, set it and forget it. Investors just like you in 2000 and in 2008 saw often 30, 40, and 50% losses or drawdowns in the value of their portfolio, not once but twice in 12 years. The problem too many of you investors face is this. If you're working in a brokerage environment or with an insurance agent or somebody at a bank investment department, you are almost assured that you probably have what's called a brokerage account. A brokerage account is not managed money. What that means now is about 90% of investors are working with what's called a non-fiduciary, meaning under suitability, and your money's actually not managed. In a brokerage account, you are responsible to manage your own money. So when you sat down with that person, he put you in 10 or 12 mutual funds, or he put you in a couple of variable annuities, or he sold you a bunch of stocks or bonds. It's called what I call a set it and forget it, pie-shaped chart asset allocation. The problem with that is you bought investments, they were set to be left alone. You thought that broker or so-called advisor was actually being paid to watch them. Guess again. Their job is to sell investments, not actually manage your money in a brokerage account. So now what happens is the markets start going down in recession in 2000. Your money goes down 40, 50%. You never got a phone call that you needed to sell, and you never will. 2008 comes back around, and your portfolio goes down again 30, 40, 50%. This, of course, is called blind diversification, and it's called asset allocation. You bought and held. Again, you made the mistake, unfortunately, in 2000, and you made it again in 2008. The question I have for all my TV listeners tonight is simple. Are you going to do a repeat or a three-peat of a 30 to 50% loss in your portfolio again in the next recession? I can guarantee you we will have more recessions over the next 5, 10, 15, 25 years. Statistically, equity markets drop quite a bit. I think currently the bond market is set up for a big loss or substandard rates of return given where interest rates are. If you've got a brokerage account and unfortunately you mistake a brokerage account for a managed money account, you may suffer these same devastating losses, not only twice from the last two recessions, but a three-peat in the next one. Remember, folks, buy and hold, set it and forget it is not an investment strategy. So what you need to understand as an investor is, A, does the person you trust with your money actually manage your money? And B, what is your investment strategy? And does it include risk management or when to sell? One of the things we do with every one of our new clients that come in is we educate them not only our investment strategy, why it's adaptive and objective, but we also teach you when to sell. We put in place risk management measures. So we know when we want to sell. We know when it's time to reduce risk in a portfolio. Again, buy and hold hasn't worked twice in the last two recessions, and it's probably not going to work a third time. I'm going to go to a quick break, and I'll be right back with your calls, your questions after this. Hi, I'm Brian Rezny. If you're like many investors, you've lost a lot of your retirement assets due to poor investment management or being sold investments that are often better for that so-called advisor than you. Most so-called advisors are just salespeople or brokers for investments their firms represent. No real advice at all. If you're tired of bad investment advice and are ready for positive change for your retirement, call my firm for a consultation. Don't settle for bad investment advice. There is a difference. Call us today. And we're back, and we are going to be taking some phone calls pretty soon with questions that you have about your portfolio. Today we're talking, I talked earlier in my first segment about variable annuities and why they are dangerous to your wealth, not only because of the mediocre investment options they offer, but the ridiculous expenses internally they come against you and your money every single year. And again, we offer you, if you own one of these variable annuities or any poor investments, or you're not happy with your portfolio, call my firm for a consultation. Let's sit down. It's easy to talk about your portfolio so we can find out exactly what you need to do to fix the crux of the problem. I'm talking right now more about investing and investment strategy. We've had two major recessions in the last 12 years. Retirees, unfortunately, mistakenly believe their broker in a brokerage account actually manages their money. I'm sorry to tell you, that's simply not the case. So once you realize that you've got a brokerage account and your broker is not responsible, or your so-called advisor, that at the end of the day, you need to realize an investment strategy is important. Once you develop an investment strategy, I'm going to tell you a couple traits to our investment strategy, and your investment strategy needs to have these same traits in order to have a chance of success with your retirement portfolio. First off, your investment strategy must be objective and it must be adaptive. Let me talk about objectivity first. Objectivity basically means one thing. If your portfolio strategy is going to be objective, it means no personal bias or emotions are put into your decision. Your investment strategy needs to be in writing and it needs to be objective. It can't be but or this or that could happen. It has to be around parameters that actually trigger buys and sells in your portfolio. The problem that I find a lot of retirees make is they base their decisions on emotion. After things have dropped 30-40%, then you want to sell. That's emotional. You should have sold a long time ago, but unfortunately, again, you happen to have a broker in a brokerage account. By the way, a little tip, there are advisory accounts and there are fee-only money managers like Rezny Wealth Management who don't leave you out there to ride the roller coaster down 40-50%. So at the end of the day, you either have a brokerage account or you have a fee-only money manager that actually is under a registered investment advisory agreement to manage your portfolio. So that's what you want to look for. The other part of your strategy needs to be what? Adaptive. I'm going to tell you I see this as a major problem for a lot of retirees. If I go back to about 90% of investors are probably working with a broker, brokerage firm, an investment person at a bank investment department, or an insurance broker, you're again working with somebody who sells investments and actually doesn't manage portfolios. This is a big mistake investors make. So since that person actually doesn't manage your portfolio, nor do they have an investment strategy, your strategy probably isn't adaptive. And what I mean by this is simple. Let's say you have a portfolio. It's mainly comprised of mutual funds that are in the stock market. When the stock market goes down, all your portfolio goes down. Typically in recessions, it might take anywhere from 12 to 15 or 18 months for the market to bottom. If your portfolio is not adaptive and you're only in one asset category, everything goes down. So some people do what's called asset allocation. That's not a lot better. They put half their money in bonds, they put half the money in stock. Well, the stock market half still goes way down. Now with interest rates being at all-time lows, there's a good chance that bond portion of your portfolio could also go quite a bit down depending what interest rates do. So again, your strategy has got to be objective, not based upon emotion, and it has to be adaptive. It needs to be able to change based upon changing market conditions, meaning your portfolio should be able to go conservative when it needs to be, or more growth or income oriented when it's appropriate. Relative strength is a great way to look at a portfolio strategy. Relatively stronger assets going up in an uptrend typically have outperformed other assets. Well, let me explain that. A rising tide typically lifts all boats, but an asset category that's going up quicker, typically over certain time frames, has been shown to outperform. So what I want to say to you is this: relative strength ranks different asset categories against themselves. You want to own relatively stronger assets, and you want to sell relatively weaker assets. Relatively weaker investment sectors historically underperform. We call it the slowest horse. I'm going to put it all together in a picture for you in just a minute. So remember this: you want assets and asset categories that are rising. When asset categories start rolling over and going down, you want to look at being a net seller of that category. You don't want to add, you do not want to add money to assets going down or that are relatively weak. I'll give you an example. If I look at the basic equity market this year and I look at another asset category called gold. So if I looked at gold and I looked at the stock market, gold is clearly underperforming the equity market. It's relatively weak, and it has been all year. So if you're one of those investors who are one of these asset allocators or buy and hold, and you held gold since the beginning of the year, you're down almost 15%. The equity markets are almost up 15%. So again, sell what's getting weak, own what's relatively strong. If the stock market starts to get weak, of course you would sell that. So at the end of the day, relative strength or relative weakness. Remember that terminology. Our global tactical opportunity portfolios at Rezny Wealth Management is pretty simple. We look at a stable of different horses, meaning these are all asset categories. Everything from cash, bonds, equities, real estate, all different categories. They're in the stable. We don't own them. What we do is we actually rank all of these categories based upon relative strength, and we own typically 4 to 5 of those sectors or categories in our investment managed accounts. By doing that, we own what's relatively stronger, and we sell or don't own what's relatively weak. Those weaker assets or weaker categories that are underperforming stay in the stable. By doing this, and by consistently re-ranking our sectors, we are able to adjust our client portfolios to changing market conditions. So instead of being one-sided or just in equities or just in bonds or just in stock or bonds, we look at all categories around the world. There's times our client portfolios that are more growth-oriented today can be very conservative and protective when it needs to be. Like times like now, the economy we're seeing is getting better. Equities are outperforming, yet a lot of investors are underperforming or missing because they're scared and their strategy is no strategy at all, or it's gut or emotional reaction. That's going to cause you weak returns and poor performance. I'm going to go to a quick question. Peter in Marco Island. I am nervous that I have too much money in bonds. I am 72. I have approximately 70% of my money in bond funds. What do you think? Peter, let me tell you what. 70% of your money in bond mutual funds doesn't make a lot of sense given where rates are. Now, I'm not sure what kind of bond funds you own, whether they're short-term, intermediate, or long-term, or what style of bonds are owned in those mutual funds. But what I can tell you is this. You're 70 years old. If you are married, you have a life expectancy, probably one of you, either you or your wife, into your 90s. So that's a 20-year time horizon. What I would tell you is owning 70% of your portfolio in the lowest interest rate in history doesn't sound like a good recipe. I would seriously consider reducing some of your bond exposure and looking at other alternative income areas that can give you income and or some growth. Remember, you don't have to have income assets just to get growth. You can have growth assets and take some of that growth off each year. I would also suggest maybe call my office, schedule an appointment at our Naples office, sit down with us, let's review your portfolio in detail so we can actually give you a better handle on exactly what you're doing, and we can show you our strategy, which is much more adaptive than what you're currently doing. I'm going to take a short break. I'll be right back with more phone calls and questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Do you know the biggest risks to your retirement and investments? One is entrusting your hard-earned money to someone who doesn't work in your best interest. The other is a lack of a detailed investment strategy to meet your goals. Both risks can be devastating, but both can be corrected. Rezny Wealth Management, fee-only money management. Don't settle for questionable investment advice. Call my firm for a consultation. There is a difference. And we're back. I'm taking some live calls right now. If you have questions about your portfolio, call the number on the bottom of the screen. One of our studio producers will take your question, and then I'll answer it while you sit back in your sofa there and get a good answer to your investment questions. John in Naples, is a strong employment report a game changer for the bonds, stocks, and the precious metals market? John, great question. Bottom line is this. We're actually seeing an improvement in the U.S. economy. And what does that mean? It means that a lot of investors, unfortunately, as I talked earlier, base their decisions on emotions. They're running scared. That's a bad situation. So what I'm going to tell you is this. The economy is slowly getting better, not as fast as anybody wants. The problem that I think too many investors face is all the hype and news that you hear about the world and about all the stuff going on and how we're in debt and this is a problem and that's a problem. Folks, there's been news forever. The problem today is there's too much news. You hear about problems too many times throughout the day. Nothing is different investing today as it was 30, 40, 50 years ago. The problem is there's a lot of news that turns into noise and people make more emotional decisions with their portfolio. With the economy getting better, with unemployment getting better, firmly I believe we could be set up for a long-term growth in the U.S. economy. Does that mean the stock market is going to go straight up for the next 10 years? Absolutely not. But what that tells me is if you run a relative strength strategy and one of the areas that is relatively strong is in your portfolio, and for us now is some of the equity market, that gives you a great chance to make a return on your money. At the end of the day, again, your strategy's got to be objective, emotion's got to be taken out, and it has to be adaptive. Not one-sided, lopsided, and buy and hold. That's a mistake. Dennis in Fort Myers, I have 3 equity index annuities my advisor sold me over 4 years ago. None have done well compared to the market as he claimed they would when he sold them to me. What can I do now? Oh, Dennis, let me tell you what. First off, your advisor is no more than an insurance salesman with an insurance license. Equity index annuities next to variable annuities are one of the most complex products there are for you investors and you retirees. In fact, the Security and Exchange Commission, FINRA, who governs the brokers, and the Department of Florida of Finance, the CFO of Florida, have all sent out warnings to seniors on deceptive sales practices with fixed equity index annuities. The bottom line is this. You were sold a bag of goods buying all these fixed equity index annuities. Fixed equity index annuities are sold with these lavish claims of bonuses and these high returns. That's not going to happen. At the end of the day, the broker, the salesman who sold you those equity index annuities, Dennis, probably doesn't know how those things work any more than you do before you bought them. These things are highly complex. They are toxic. Unfortunately, the average equity index annuity has a surrender period, get this, between 8 and over 20 years. So if you bought these 3 or 4 years ago, you might still have another 10-year surrender penalty. That is ridiculous. What I'll tell you is this. I've reviewed dozens of equity index annuities from the big sellers out there. We get these in our office all the time, and people are not happy they bought them 2 or 3 years like you after you bought them. You were sold based upon untrue claims of what you could make, and unfortunately, you've got exactly what you bought into. You got a low return investment that keeps your money locked up often up to 20 years. At the end of the day, equity index annuities probably might make over an average 10 or 20 year time frame, maybe 2 to 3% today if you're lucky. You can decide if you want to surrender them, but again, you're going to have a surrender penalty. You have to look at the surrender penalty and what the other opportunities out there are. What I would tell you, before you buy one of these products, you need to read the fine print. Unfortunately for you retirees, the fine print on these fixed equity index annuities is so complex, you better be a physicist, a PhD, and everything else in order to even remotely be able to understand these products. What I'm going to recommend, never buy one of these again, because again, the person selling them is no more than an insurance salesman with a license to sell something that isn't good for your portfolio. Robert in Fort Myers, where can I find the best high-yield income opportunities? You know, unfortunately, with interest rates being at all-time lows, there's not a lot of places where retirees can find high-income opportunities. But what I would tell you is this. Look at other areas, not just fixed income for income. You might look at utilities. You might look at emerging market bonds, maybe preferred bonds. You might even look at global bonds outside the U.S. So at the end of the day, the only place to invest is not just bond mutual funds for income. Look for other ideas. You might want to actually make an appointment at one of our offices, either Fort Myers or Naples. Let us sit down with you, talk about your portfolio, and we can actually put together an income portfolio that can have a chance for income and, better yet, a chance to grow and be adaptive to changing market conditions. You would benefit from a consultation with my firm if you want to avoid outliving your money during retirement. You want to grow and protect your investment and retirement. You want to sleep well at night. You want less stress over your investments. And you want to enjoy retirement with your family. Every single week we get calls into our office. People want consultations. Sometimes they've listened to my TV or radio show for years. I offer you this. When you make an appointment at our office, it's not going to be like any other appointment you've ever had. We're not a Wall Street firm. We're not a broker. We're not a so-called advisor. We're a fee-only money manager. We work in our client's best interest as a true fiduciary. And the only thing we sell is high-quality investment management. If you're sick and tired of bad investment advice, if you want a fair chance at making a return on your money, if you want to sit down with a firm that only interest is to make a return for you on your portfolio, call our firm for a consultation. There is a substantial difference when you deal with a fee-only money management firm like Rezny Wealth Management. We do have offices in Naples. We do have offices in Fort Myers. Call our office. Our number is at the bottom of the screen right now. Also, please visit my website. We have some upcoming, what they're called is Grow and Protect workshops. These are perfect for you retirees who are concerned about outliving your money. If you're concerned about the advice you're getting, if you want to learn how real investing works, attend one of my upcoming workshops. They're not free lunch seminars. They're actual workshops where you're going to learn what you never learned before. Go to ReznyWealth.com. That's ReznyWealth.com. Until next week, make sure you have yourself a safe and profitable week.